Good evening. This is Ken Long from Tortoise Capital with a quick study on the effect of moving averages as a filter for long-term buy and hold. And we're going to do some back testing using etfreeplay.com from 3 January 2003 to June 1st, 2011. Now to read this chart, the S&P buy and hold strategy returned net 73.4% in those 8.5 years. And the volatility was 20.9, and then the return divided by volatility, just as a quick measure, was 3.5. We then took a look at a number of different passive strategies. The Harry Brown portfolio, which holds equal amounts of the Dow Jones 30 Industrials, gold, long-term treasuries, and short-term treasuries in equal percentages, and then rebalances annually. We took a look at that and said, well, what if you held all four of those as long as the price at the end of the month or at the start of the new month was better than the 2-month moving average? If you did, it returned 76%, had a volatility of 5.4 and a return divided by volatility of 14.1. So in other words, you would hold all four unless any one of those was less than its 2-month moving average, in which case you just held SHY, which is the short-term treasuries, and then so on up the chart. So under the column of 3, this would be you would hold those four symbols equally and rebalance annually unless any one of them was less than their 3-month moving average, in which case you held SHY and so on. And so the best performance in that period, or of those periods, looking at a 2-month through a 9-month moving average, was 99 percentage points, and the minimum volatility was 5.4, and then the best return divided by volatility was 16.2 ratio, holding on 7 months. So then we took a look at 4 other strategies: the passive annual strategy with equal amounts, and then passive annual using 5 symbols, use a slightly more diverse holding period. Passive annual with 10 ETFs and then equally held, and passive annual of 10 with diverse being held. And then we compared it to the S&P 500 if you just held it with moving averages. More on that in a second. Well, when all the math is said and done, what each of these has to do, which each of these strategies proposes to do, is do better than the S&P 500 buy and hold strategy. And generally speaking, they do in every case, with the exception of a couple of these here with the Brown portfolio. The Brown portfolio features the least level of return, but has by far the lowest level of volatility, and so it's actually very attractive on a reward to risk basis. It did very well during the inverse bubble years of 2008, 2009, the big bears. So what I've done is I've highlighted in yellow the best performers on the return, and then on the return divided by volatility. And what you see there is there's a persistent region in this 4 or 5 month period using these strategies when that moving average filter actually does a pretty good job of improving return and reducing volatility. In every case, they're better. They give you better returns and lower volatility than a simple buy and hold strategy in the S&P. Now, when we ran it on the S&P itself, you can see, with the exception of the 2 and the 3 month period, you actually are getting better real returns than just a straight buy and hold strategy, and the best one's out here at the 8-month, which corresponds very nicely, by the way, with the 200-day moving average. So that's some additional validity for the value of the 200 period moving average. I then took a look at the same numbers or the same strategy, looking at a variety of other assets to see how persistent this moving average strategy would be. In every case, the first column represents what a simple buy and hold strategy starting on 3 January 2003, with the exception of gold and the blended commodities and USO, which were not available that far back. And so those tests started on November 04, respectively, for gold, April 05 and April 06 for the blended currencies, and then barrel of oil. In every case, the moving average strategy was better than the simple buy and hold, with the single exception of gold, which returned 239% from November 04 compared to the lesser returns if you used any moving average filter. The closest one was the 7-month, which gets you 220%. And in this period too, under those individual symbols or indexes, that 4 and 5-month period does seem pretty good. The interesting exception is out here in Brazil and Latin America, which Brazil returned an astonishing 998%, and you can see how the effect is modulated by moving averages, and with the 9-month moving average actually looking pretty good on both Brazil and Latin America. Now, Latin America ILF actually dramatically improves really from 4 months on out. There's sort of this anomaly here in the 6, 7, and 8-month period for EWZ, but even so, you'd still been pretty happy, I think, with 452% in the same period. That the S&P is returning 73% using buy and hold. Oil, interestingly, if you just bought and hold it, was down 44%, and so the use of any moving average filter returns you a pretty good net improvement using oil. So what I take away from this chart is that the passive annuals are all pretty valid. The addition of a 4 or 5-month moving average filter looks to be pretty good. We're going to see in a different report that a 4-month filter using the monthly rebalancing is actually pretty effective too. So I think there's some kind of persistent value here in the 4 to 5-month period, and that generally equates to about a 100-day moving average. If you count for 22 days of trading per month, this would be 88, and then this would be 110. So if you take that average, it's right about in the middle. It would be a 100-day moving average. So there's something to be said for adding that to our basic charts for intermediate term positions. This is Ken Long from Tortoise Capital with some insights into moving average filters for long-term trading positions. Thanks for your attention.